Welcome back, traders. Today we're going to be learning candlestick patterns. This is part of the Mastering Stock Chart Analysis series. Let's get straight into it. So we're going to be learning 16 candlestick patterns every trader should know. So we've already learned throughout the series what a candlestick is and how to read the different types of candlesticks. First, we're starting with 6 bullish candlestick patterns. So we have the hammer. The hammer candlestick pattern is formed of a short body with a long lower wick. So we have a short body and a long lower wick or down wick, and is found at the bottom of a downtrend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Next, we have the inverse hammer. A similarly bullish pattern is the inverted hammer, the only difference being that the upper wick is long while the lower wick is short. So we have a small body, a little low wick, and a big top wick. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. Next, we have bullish engulfing. The bullish engulfing pattern is formed of 2 candlesticks. The first candlestick is a short red body that is completely engulfed by a larger green candle. So here we can see a small red candle with some little top wick and a bigger bottom wick, and we can see a bigger green candle, and this signals, okay, sellers are getting taken over by the buyers. So we can see the bullish market pushes the price up, accumulating in an obvious win for buyers. Next, we have the piercing line. The piercing line is a 2-stick pattern made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous day. So that can signal a reversal signal after a downtrend. Next, we have the morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a 3-stick pattern, one short body candle between a long red and long green candle. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. You may also see this type of candle formation out of a demand zone. Next, we have 3 white soldiers. The 3 white soldiers pattern occurs over 3 days. It consists of consecutive long green or white candles with small wicks, which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. So as we can see, with 3 large green candles 3 days in a row, that's a lot of buying pressure, so we can potentially keep going in the upward direction. Next, we have 6 bearish candlestick patterns. First, the hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. So yes, it is a hammer, but the difference is it forms at the end of an uptrend, signaling that we start getting bearish, potentially. So it indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Next, we have a shooting star. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. Bearish engulfing, basically the opposite of bullish engulfing, and it means that we have a small green body candle and a larger red candle, signaling okay, buyer or sellers are taking over buyers, and that could signal we may start going in the a bearish direction. So it signifies a peak or slowdown of price movement. It is a sign of impeding market downturn. The lower the second candle goes, the more significant the trend is likely to be. So if we have, depending on the size of the red candle, if we have a large one maybe down here, that could signal, okay, it's starting to become very bearish. Next, we have the evening star, three candlestick pattern that is equivalent of the bullish morning star. It is formed of a short candle and sandwiched between a long green candle and a large red candlestick. It indicates the reversal of a uptrend and is particularly strong when the third candlestick erases the gains of the first candlestick. So this can also signal that we are hitting a supply zone and that we will potentially start heading in the other direction. Next, we have three black crows. Comprises of three consecutive long red days with a short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during three successive trading days. So when you have 3 days in a row, large red candles, that could signal there's a lot of selling pressure and you will potentially keep heading in the bearish direction. Next, we have dark cloud cover. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises two candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. So next we're going to go over 4 continuation candlestick patterns. First, we'll read over what these exactly are. So if a candlestick pattern doesn't indicate a change in market direction, it is what is known as a continuation pattern. These can help traders to identify a period of rest in the market when there is a market indecision or neutral price movement. So we may see this in between demand and supply zones. First, we have the doji. When a market's open and close are almost at the same price point. The candlestick resembles a cross or a plus sign. Traders should look out for a short to non-existent body with wicks of varying length. So a small body with wicks with different lengths or varying lengths. This doji's pattern conveys a struggle between buyers and sellers that results in no net gain for either side. Alone, a doji is neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. Next, we have the spinning top. It has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher, while the bears pushed it low again. Spinning tops are interpreted as a period of consolidation or rest following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. Falling three methods. Three method formation patterns are used to predict the continuation of a current event trend, be it bearish or bullish. The bearish pattern is called the falling three method. It is formed of a long red body followed by three small green bodies and another red body. The green candles are all contained within the range of the bearish bodies. It shows that traders that the bulls do not have enough strength to reverse the trend. Rising three method. So it's the opposite of this pattern. It's just meaning that buyers are taking over sellers, and our sellers, they don't have enough selling pressure to change trend. So despite some selling pressures, buyers are retaining control of the market. So that is going to be it for this video, guys. Thanks for watching.